So this is, I believe, it's a textbook example of how geopolitics translates into macroeconomics. Now, there are a couple of channels how this is impacting India. Now, higher import prices, as a result of which there will be higher costs, transportation costs to be specific. And if the transportation costs increase, that would imply that food, groceries, goods in general, the prices would increase. In this particular case, of course, because import prices have gone up, export has been as it is, as a result of which our trade deficit is widening. Imagine you are now purchasing or sort of transacting to purchase the same amount of oil with a higher number of dollars. The quantity of dollars that you are sort of transacting, as a result of which the value of the dollar has increased relative to the rupee. Global uncertainty, what it does is sort of investors kind of look for safer locations where they can move their assets to. And the immediate activity that takes place is that a lot of these assets move out, or capital outflows happen from emerging markets or emerging economies, and India is an emerging economy at this particular point.
Hello and welcome to our very first episode of Bidisha with Dr. Bidisha Bhattacharya, our consulting editor for economics. We are very excited to have you. Thank you. Welcome to the new show. So I'll start off with the first question, which is, of course, on the US, Israel and Iran war. So this question is by Narendra Arya. He's asking, US Israel versus Iran war is the biggest blow on the world economy right now. How badly and for how long will Indian economy suffer amid this worsening global politics?
So this is, I believe, it's a textbook example of how geopolitics translates into macroeconomics. Now, there are a couple of channels how this is impacting India, and I'll get into, what is kind of the determining factor as to what would be the intensity of the impact on India. The primary channel being oil shock.
Right.
Now, India imports approximately 85% of its oil, which is a significant amount. So, in this sort of situation or this particular channel, there comes a very important economic concept called the terms of trade. So, terms of trade is basically the ratio of export prices to import prices. Now, what happens is here the import prices have shot up, as a result of which the denominator has increased, so the terms of trade has worsened. That pretty much makes India look relatively poorer to the rest of the world. So, in this particular situation, there's also another factor that follows from here, which is the second factor, which is inflation. Now, higher import prices, as a result of which there will be higher costs, transportation costs to be specific. And if the transportation costs increase, that would imply that food, groceries, goods in general, the prices would increase. So that is something where inflation kind of gets impacted and inflation increases. Now comes to the third factor, which is one of the most important areas in my opinion, which is the external sector. Now here, two macroeconomic factors come into play and also associated with trade, one being current account balance and the other being the exchange rate. Now first let's talk about current account balance. Now in this particular case, of course, because import prices have gone up, export has been as it is, as a result of which our trade deficit is widening. As an economy in general, we have a large current account deficit, and trade balance kind of covers a major chunk of this current account balance.
Right.
Now, as a result of which the current account deficit has been widening. Now, what's happening at the same time? Imagine you are now purchasing or sort of transacting to purchase the same amount of oil with a higher number of dollars. The quantity of dollars that you are sort of transacting, as a result of which the value of the dollar has increased relative to the rupee, and hence the rupee weakens even further. Then coming to the last factor, which I feel should be extensively discussed even more, which is financial markets.
Okay.
Now, global uncertainty, what it does is sort of investors kind of look for safer locations where they can move their assets to. And the immediate activity that takes place is that a lot of these assets move out, or capital outflows happen from emerging markets or emerging economies, and India is an emerging economy at this particular point. Now here, how much would India be impacted? That highly depends on duration. If it's short term, there'll be a little bit of temporary volatility. If it's long term, there comes the danger because there will be sustained inflation and slower growth.
Okay.
Now, this is the classic definition of stagflation, where inflation is increasing, growth is slowing down, and then eventually we get stuck in a low growth kind of a situation where obviously as a result the investment inflows stop as well. So I feel the major determining factor at this point is duration.
Right. So the next few questions, Bidisha, take us back to India. So the first question is by Krishna. They are referencing the recent paper by Arvind Subramaniam and Abhishek Anand. So his question is, how reliable is Chinese economic data?
This question, I believe, is quite imperative because China is the second largest economy and it has real implications on the global trade and investment factor as well. So, I would like to take this question in two parts. One, focusing on what the paper and the research revolved around, and the other about the Chinese data reliability. So the central question that Arvind Subramanian and Abhishek Anand asked it was a very simple question, which is China growing as fast as the official estimates suggest? Okay. Now, this sounds like a technical question, but it has real implications because China has massive infrastructure, it dominates in global manufacturing, huge sections of global supply chains it controls. So as a result of which, if the Chinese data or China's GDP is overestimated for some reason, that will have implications on the global trade forecasts. It will have implications on investment flows. It will also have implications on commodity prices. So now the most important question is, why doubt the Chinese data at all? Because in every economy, the GDP can be overestimated a little here and there. But what is this entire doubt about Chinese data? Right. Because Subramanian and Anand's paper is not the only paper that's sort of focuses on this topic. There are multiple studies. Now, in this case, an important concept comes into the picture, which is statistical credibility. Okay. Now, usually in open economies, what happens is data is collected by independent statistical agencies, and their sort of revisions are also happening publicly. The data system is transparent. In the Chinese economy, however, the growth forecasts or economic forecasts are politically significant, and local officials in China as well, they are evaluated on the basis of growth performance, and the data system is less transparent. Now, in this particular situation, it's a little difficult to understand exactly how GDP is being measured. So what Subramanian and Anand did, which was different in comparison to the other research sort of materials, is that they looked for proxy indicators apart from relying just on official GDP. Okay. So there are three primary indicators that they focus on, and I believe that a lot of thought process has gone behind these particular indicators. One being nighttime satellite lights. Okay. Now, the longer the light is on, basically, and of course these factors also have to be measurable at the same time. They can't be qualitative factors. So longer the lights stay on is, of course, that kind of signals longer economic activity. Then comes electricity consumption, factories, industries, services, education. From that front, that is an important indicator. And the third indicator is trade flows, which is exports and imports. Now, these three factors or these three indicators are difficult to manipulate at scale altogether. So the broader finding that of their paper and multiple other papers is that the GDP is slightly overestimated but not completely falsified. What do I mean by that? If China's GDP is 5%, is being reported 5%, it might be between 3.5 to 4.5%, but the economic activity of China is completely undeniable. Okay. And the reality here as to why is India very interested, in this particular angle of China, because if at all China's GDP is being overestimated, then that would signal that global demand is weakening because of the impact from a trade and a macroeconomic perspective that China has on the rest of the world. Now, if global demand basically weakens, then the supply chain kind of shifts. And if supply chain shifts, opportunities open up for India.
Right.
As a result of which, which is why this paper has received the kind of attention that it deserves. Yeah, that's about.
So we're talking about opportunities that India could look at right now. So which brings me to the next question, which has been asked by Dr. Roy. They're asking, central government wants to add an economic stabilization fund.
Yeah.
Is this necessarily a good idea? We will be tying up funds for fiscal headroom for some calamity in the future, while they could have been used in the present for growth. At the same time, is it not better to let the markets decide?
Wonderful. I believe that this particular question kind of focuses on how governments manage uncertainty over time. And here a very important macroeconomic concept comes into play, which is the counter-cyclical fiscal policy.
Okay.
Now, what is exactly this counter-cyclical fiscal policy? It basically implies that during good times, let's say economic booms, the government saves.
Okay.
And during downturns or crisis periods, the government spends. Now, if you look at the trajectory in India, this is the exact opposite of what happens politically in the sphere, right? So now the economic stabilization fund is nothing but a pool of savings that the government would park for crisis periods, for difficult periods in the future. Now, why does India need it specifically? India is exposed to recurring shocks. Number one, we are already in the midst of that shock, which is oil price volatility.
Right.
And this keeps happening, and this will keep happening, with any kind of tension in the Middle East, to be specific. Then coming to the next recurring shock, which is global financial cycles. And then definitely the geopolitical risks that we have. Now, every time a shock hits, the government revenue falls and the government expenditure has to increase.
Right.
If there is no such fund in place, what the government has to do, and this has happened in the past multiple times, government borrows literally overnight. The speed increases and huge amounts of borrowing take place. Now, it's a no-brainer. When government borrows overnight, the interest rates will shoot up.
Right.
Now, the minute interest rates shoot up, private investment is the factor that will get crowded out. This is that classic crowding out effect that we talk about, where private investment is the first factor that starts getting crowded out. Now, this criticism, and rightly so, this trade-off between present growth and future stability, it's completely understandable. Present growth is, why not spend more on infrastructure? Why not spend more on social sector reforms? But future stability is also extremely important, because the geopolitical order, the way it looks right now, I don't think this is the last crisis that we are going to experience. There are going to be multiple such conflicts in the future as well. Now comes the other part of the question that Dr. Roy has asked, which I find very intriguing and interesting, is that should markets step in? Now, in my opinion, absolutely not. Because markets are efficient in many other areas, but not this. Markets are good with allocating capital efficiently, but markets cannot offer public insurance.
Right.
Governments are the one who step into stabilizing the economy. They can provide fiscal stimulus. They can spend accordingly in certain sections. So, in my opinion, markets should not interfere in this area, and there are multiple global examples as well. Norway has a sovereign wealth fund. Chile has sort of a commodity stabilization fund, and these funds are used for sort of smoothing volatility, ensuring macro stability. So that is something, an economic stabilization fund, given the geopolitical risks and our neighboring tensions as well, I feel it's extremely important.
Bidisha, next question is by Anubhav Saxena. He is asking, FIIs have been selling continuously since the LTCG tax was introduced in 2018, but the government seems indifferent to the stock market fall or rupee fall due to the FII selling. This indifference to the stock market was never seen with any previous government. What is Modi government's reason and thought process regarding FIIs?
This is quite an interesting question, because it gives me the space to address a misunderstanding that's going around here in the market. Especially, first, it's important to understand what is an FII and what is LTCG tax.
Right.
FII is foreign institutional investors. It's basically global and foreign funds that invest in the Indian markets. Second is the LTCG tax. the long-term capital gains tax. Now, this is basically a tax that is imposed on profits for holding certain assets for the long term. For instance, in equities, you have 10%, for profits more than above 1 lakh. Now, in this particular situation, it's important to understand foreign institutional investors or FIIs in general, they don't really focus on, or they are not determined, their movements are not determined by LTCG tax, but what's happening in the global world order. So the primary driver for this FII selling is not LTCG tax, but global interest rates.
Okay.
When US interest rates, especially in the US, when US interest rates increase, then automatically what happens, of course, it's a lucrative area, the US assets become more attractive. And as I had mentioned earlier as well in the first question, if I'm not wrong, from the financial market perspective, these capital outflows start happening from emerging market economies. So right now, FII selling out has no relation with LTCG tax.
Okay.
It has a relation with the global interest rates acting up and increasing. Now coming to the question or that part as to why is Indian government not bothered, let's put it that way. It's not that Indian government is not bothered. There has been a shift from indifference to sort of a strategic move. And I'll explain why. India, for the first time, is experiencing very strong domestic institutional investors. What do I mean by that? Mutual funds, SIPs, insurance, pensions. These are having a very strong hold, which have, here, if you rely on domestic institutional investment specifically, then the volatility is lower, there is more long-term stability, and as a result of which government is not much worried, if the FIIs are selling out, there is nothing to worry as such from, and especially definitely not from an LTCG tax point of view. They are more focused on sort of building domestic macro stability and discipline, rather than, if there is any connect between the two.
Right. Bidisha, we come to our last question today, which I think you have a lot to say about, and you've done an episode of economics on it. This question is by Senapati. They're asking, with India signing several new trade deals and lowering trade barriers, can this create a wave of creative destruction in domestic industries similar to the post 1991 reforms? Or are these deals too limited in scope to trigger such shifts?
This is, of course, as you rightly stated, I think towards the end of October, I had written a piece regarding this. And it's a very good question, and definitely, especially the 1991 analogy as well. In 2025, the Nobel Memorial Prize for Economics was announced, and Joel Mokyr, Philippe Aghion, and Peter Howitt, I hope I'm not butchering the names, but they had won, this Nobel, and it highly focused on creative destruction. Creative destruction basically says, or let's say innovation replacing older systems. That is creative destruction at the end of the day. It means that growth is not determined by adding more labor and capital, but on the innovation that replaces older systems.
Right.
Now, this goes back to Joseph Schumpeter, who used to describe capitalism as a process of continuous transformation. So first, it's important to understand what is exactly creative destruction and what happens when this phenomenon takes place. When creative destruction takes place, new technologies emerge, old technologies deplete. As a result, the inefficient firms sort of lose out, they lose the market share, and productive firms, they expand. Now, in this particular situation, if I have to connect it with the trade deals today, now see, it's important to understand from the basic structure of trade agreements. Every time India signs a trade agreement with any other country, two things happen. Tariffs fall and foreign competition increases. That is the whole intention of signing a trade agreement. Now, this leads to efficient firms getting more market share, efficient firms getting the kind of investment that they do, and inefficient firms losing out market share. Is this similar to 1991? In my opinion, partly, but not entirely. Because 1991 reforms were sudden, they were economy-wide, they were disruptive. today's trade deals or trade agreements that are being signed are gradual. They are sector specific. That's the beauty of every trade agreement that we are signing. They are sector specific and they are negotiated. Now, I spoke specifically in my article as to, what is that particular drawback in India. India has been very, very protective when it comes to this creative destruction factors. They have a tendency of protecting incumbents. They are worried about sort of job losses. They prioritize stability over short term. Stability over long term stability, as a result of which what happens is, in the temporary sort of situation, we experience something called stagnated or stagnation, or a stagnation trap rather. Now, it's important to understand what is the social cost. Creative destruction increases productivity, but at the same time, it is very true that creative destruction results in job losses.
Right.
Which is why when these policies are being designed, especially by an economy like India, reskilling, labor mobility, these are the areas that needs to be looked into. And creative destruction, because if creative destruction does not take place, then we will never be able to move from this growth to the developmental phase, or this emerging Viksit Bharat 2047 that we are envisioning right now. So I think more than thinking about as to, what are the job losses or what are the downsides of creative destruction, it's important to understand the designing of the policies, the pattern in which the policies should be designed, so that they are transparent, they are disciplined, the revisions that are taking place are public and open to sort of criticism. So yeah.
Bidisha, what an incredibly enriching conversation. We have reached the end of our episode today. Thank you so much for taking the questions from our wonderful audience. Also, we received a lot of questions from you, and unfortunately, we couldn't take them. So, if you want us to take more of your questions, please become a member with our YouTube channel. Thank you so much, Bidisha. We'll return to you with another episode of Bidisha Nomics next week.